All right, welcome back to Talk Tickers. It is Wednesday, January 21, 2026. We are keeping our finger on the pulse of earnings season so you don't have to. Today, we are looking at a really interesting setup in the regional banking space that, frankly, I think most people are sleeping on.
It's a classic case where the headline looks boring, but the plumbing underneath is fascinating.
Exactly. We are breaking down Mercantile Bank Corporation, ticker symbol MBWM. Now, before we get into the weeds of the numbers, I want to start where we always start, the vibe check.
Yeah.
Because this morning, the earnings dropped, and the market reaction was, well, I think polite is the word.
Polite is a very diplomatic way to put it. The stock moved up exactly 0.78% on the day. It didn't tank, but it certainly didn't mean anything.
Right, and usually when I see a stock move less than 1% on earnings, I think, okay, nothing to see here. But you're telling me that the lack of movement is actually the story.
It is the story. Look at the volume. It was trading at about, 0.74 times its average daily volume. So barely 3/4 of the usual crowd even bothered to trade it. What that tells you is that there was no panic. The bears didn't see anything scary enough to sell, but the bulls, they didn't see enough fireworks to stampede in. It's a wait-and-see market.
It feels very workmanlike. Like the market looked at the report, nodded, said, okay, you didn't break anything, and then just went back to lunch.
Exactly. But workmanlike quarters are often where the real alpha is hiding because the algorithms, they just get bored. If you actually dig into how they made their money this quarter, it's impressive.
So let's unpack the headline numbers first. We had an earnings beat.
We did. They reported GAAP diluted EPS, that's earnings per share of $1.40. The consensus on the street was $1.37, so a solid 3-cent beat. Not earth-shattering, but they cleared the bar.
Okay, so they made more profit than expected. But then I look at the top line, the revenue, and it's a little softer. Revenue came in at $62.07 million versus the expected $62.25 million.
It's a light miss. Yeah, they were about $170,000 light. Now, for a bank with nearly $6 billion in assets, $170,000 is basically a rounding error. But it does signal that loan demand, the raw engine of revenue, wasn't quite as hot as some people hoped.
However, looking at the bottom line, net income for the quarter was $22.8 million. That's significantly higher than the $19.6 million they did in the same quarter last year.
Right.
And for the full year of 2025, they brought in nearly $89 million. That's $5.47 per share.
Which is a very healthy number. But there is one stat in this report that I think matters more than EPS or revenue. If you are a serious bank investor, this is the number you tattoo on your arm. Tangible book value.
PBV. Let's pause here for a second. For the listener who might be used to trading tech stocks where we look at, PE ratios or growth rates, why is tangible book value the real scorecard for a bank?
Think of tangible book value as the liquidation value of the house. If Mercantile Bank closed its stores tomorrow, sold every loan, paid off every depositor, and sold the furniture in the lobby, TBV is roughly what the shareholders would walk away with. It is the hard equity, the floor.
Okay, so it's the actual value of the assets minus the liabilities and all that intangible fluff like goodwill.
Exactly. And for Mercantile, that number grew to $36.78 per share. That is up almost 11% year over year.
11% growth in hard equity seems. That's really high, isn't it?
It is massive. You have to remember the context of 2025. Regional banks were fighting for their lives. We had yield curve inversions. We had deposit flight scares. For a bank to compound its tangible value by double digits in a year like that, that is a flex. It tells you they aren't just surviving the macro environment, they're compounding wealth through it.
And looking at the balance sheet, it seems like they achieved that growth without taking on crazy risks. I was looking at the asset quality metrics, specifically non-performing loans.
This is the can the borrowers pay us back metric.
Right. And it's at 11 basis points, 0.11%.
Which is statistically zero. It's nothing.
And their allowance for credit losses, basically the rainy day fund they keep in case loans go bad, is at 1.21%.
So do the math on that. They have coverage of more than 10 times their actual bad loans. If the economy was crashing or if the soft landing we keep hearing about was actually a hard landing, you would see cracks here first. You'd see businesses in Michigan defaulting. Mercantile is showing us a smooth wall.
So we have a clean balance sheet, growing book value, and an earnings beat. But the stock barely moved. Why? I think the answer lies in the mechanics of the quarter, specifically the net interest margin. Let's do a deep dive into what I'm calling the magic trick.
It really was a bit of financial engineering wizardry. The net interest margin, or N, came in at 3.43%. That's actually up 2 basis points.
Okay, help me understand why that's weird. because late in 2025, the Fed cut rates. They cut 75 basis points total. So, standard textbook economics says when the Fed cuts rates, banks make less money. Their loans reprice lower, so they collect less interest. But Mercantile's margin went up. How?
This is a classic case of what we call defending the spread. You're right, usually asset yields fall. And to be fair, Mercantile's loan yields did fall. They dropped 28 basis points.
So they were making less on the money they lend out.
Yes. But they were incredibly aggressive on the other side of the balance sheet, the liabilities, the deposits, the money they pay to you and me.
Ah, so they cut the interest rates they pay to savers.
Aggressively. Their cost of funds dropped 30 basis points.
I see. So the loan yields dropped 28 points, but the cost of funds dropped 30 points. They won the race by 2 points.
Precisely. They widened the gap. And this tells us something very important about their structure. They aren't asset sensitive.
What does that mean in plain English?
It means their loans don't just immediately reprice down the second the Fed cuts rates.
Yeah.
They have fixed rate loans or floors in place, but they have a lot of flexibility to lower deposit rates. So when rates fall, they can protect their profit margin better than a bank that has all floating rate loans.
That is the definition of discipline. While everyone else is scrambling because their floating rate loans are earning less, Mercantile said, that's fine. We're just going to pay less for our cash.
Exactly.
Speaking of cash, we have to talk about the elephant in the room, or rather, the new bank in the room, the Eastern Michigan Bank acquisition. This deal closed on New Year's Eve, December 31st, 2025.
Right at the buzzer.
And looking at the notes here, it seems like the market might be misunderstanding why they did this deal. Usually when companies buy other companies, they talk about growth and synergy, but this wasn't really an earnings play, was it?
No, and this is crucial to understanding the stock right now. The Eastern Michigan deal was a liquidity play. It was about refueling the tank.
Refueling the tank. Break that down for me.
If you go back to 2023, Mercantile was running hot. Their loan-to-deposit ratio, basically how many dollars they lend out for every dollar they have in the vault, was at 110%.
Whoa, 110%. That means they were lending out more money than they actually had in deposit.
Exactly.
How do you even do that?
You borrow the difference, you go to the wholesale markets, you go to the Federal Home Loan Bank, but that money is expensive and it eats into your profits. Plus, it's risky. If those credit markets freeze up, you're in trouble.
So they were thirsty for deposit.
They were parched. Enter Eastern Michigan Bank. Eastern Michigan was what we call a deposit gatherer. They had a ton of loyal, sticky deposits in rural communities, but they didn't have the high-growth lending engine to use all that cash.
So the perfect match. Mercantile needs the cash. Eastern has the cash.
Precisely. Mercantile bought them to get access to that cheap deposit base. Fast forward to today, post-acquisition, and that scary 110% ratio has dropped to a very comfortable 91%.
So they went from a liquidity crunch to a liquidity surplus, like overnight.
They solved their biggest weakness. But paradoxically, solving that problem creates a new challenge.
Which is?
Now you have too much cash, you have all this money sitting there, and if you just leave it parked at the Fed, it earns a safe return, but it's not a great return. To make real money, you have to lend it out to businesses.
Which sets the stage perfectly for their growth targets. Because now that they have the fuel, they want to drive the car. Management is guiding for 5% to 7% loan growth in 2026.
Which is ambitious given the economic environment.
And they're specifically targeting Southeast Michigan, the Detroit metro area.
That's the battleground.
Yeah.
They've hired new lending teams down there. They are trying to take market share, but there is a headwind, and they were very honest about this on the call, the payoff problem.
Right. Borrowers are paying back loans faster than historical norms.
It's what I call the leaky bucket dynamic.
Explain that. Because normally getting paid back is a good thing.
In terms of safety, yes, you want your money back. But if you are a bank trying to grow your loan book, high payoffs are annoying. Imagine trying to fill a bathtub with the drain open. You're pouring new loans in at the top hiring teams in Detroit, hustling for deals. But the old loans are draining out the bottom as borrowers refinance or pay down debt.
So to get that 5% net growth, they might have to originate 15% or 20% in new loans just to stay ahead of the drain.
Exactly. It's like running up a down escalator. You have to work twice as hard just to make a little progress.
And running that escalator costs money. And this, I think, brings us to the core reason why the stock price is flat. We've got the growth target, we've got the liquidity solved, but then we look at the expense line. Expenses are up.
And this is the bear case in a nutshell.
Expenses are climbing because they're hiring these expensive lending teams in Detroit, and data processing costs are rising. But the real kicker is what you call the integration lag in your notes.
This is the specific nuance that the algorithms might be missing, or maybe they aren't missing it and they just hate it.
Unpack it for us.
Usually when Bank A buys Bank B, you expect immediate cost cuts. You fire the duplicate HR staff, you shut down the duplicate IT systems on day one, and boom, instant profit synergy.
Right, cost-cutting 101.
But Mercantile isn't doing that yet. Management admitted that the cost synergies from the Eastern deal won't really materialize until 2027.
2027. We are in January 2026. That is a lifetime in market years.
It is. And the reason is purely technical. They are switching their core digital banking provider, the software backbone of the bank, but they can't do the conversion until February 2027.
Oh, wow. So they are stuck.
They're stuck running two banks.
Yeah.
They have duplicate systems, duplicate software licenses, and they have to keep the back office staff for both systems to make sure the money doesn't disappear during the transition.
So if I'm an investor, I'm looking at this and thinking, I have to pay for the merger now. I see the expenses hitting the P&L today, but I have to wait 18 to 24 months to see the efficiency.
That is exactly the dynamic. You are paying the toll up front, but the highway doesn't open for another year and a half. The market hates waiting. It wants the efficiency ratio to drop today, not next year.
It's the show me the money problem.
Yeah.
But this brings up an interesting tension. We have the bear case. Expenses are bloated, efficiency is delayed. But let's look at the bull case again, capital allocation. They mentioned buybacks.
They did. Management signaled a stronger appetite for share repurchases now that the merger is closed. They have about $6.8 million left in the authorization.
And if you are buying the idea that the stock is artificially depressed because of these temporary expenses, then a buyback here is incredibly smart.
It's immediately accretive. If tangible book value is growing at 11% and the stock is flat, the bank is essentially saying, fine, if the market won't value us correctly, we will buy ourselves.
It puts a floor under the stock price.
It does. It tells you that insiders, the people who actually see the data, think the stock is cheap.
And zooming out to the macro level, because we always have to ask, what does this tell us about the U.S. economy? Mercantile feels like a proxy for the soft landing thesis.
100%. If you want to know if the economy is crashing, don't look at the S&P 500 tech stocks. Look at a regional bank's loan book in the Midwest. These are manufacturers, logistics companies, family businesses.
And as we noted, their credit quality is pristine.
0.11% non-performing loans. That means their borrowers are paying their bills. If we were heading into a hard recession or if rates were strangling the economy, you would see that number ticking up. You'd see cracks in the foundation. Mercantile sees none.
So let's summarize the tension here before we get to the fun part. On the bull side, we have 11% TBV growth, liquidity solved with the LDR down to 91%, and margins holding up against rate cuts.
Correct.
On the bear side, we have a revenue miss, climbing expenses, and this annoying efficiency story that is delayed until 2027 because of a software conversion.
That is the standoff. The market is weighing the future efficiency against the current cost.
Which brings us to everyone's favorite segment. The legal team makes me say this every single time, and I will say it loudly. We are just two voices on a podcast. We are not your financial advisors. Do your own diligence. Do not trade based on what we say. We're just exploring the data for entertainment.
Right. Don't sue us.
But if we were pitching this to a hedge fund investment committee, what's the trade?
All right, welcome to the This Is Not Financial Advice segment. I'm calling this pitch the 2027 time arbitrage long.
Time arbitrage. It sounds fancy. Break it down.
Here is the thesis. The market has a short attention span. The algorithms are looking at the current quarter's expenses and saying, ew, costs are up, efficiency is down, pass.
They see the bloated P&L from the duplicate systems and they punish the stock.
Exactly. They are pricing the stock based on the backpack. It's wearing the heavy costs of the merger. But we know, based on the call, that the backpack comes off in February 2027.
So the trade is to buy the ugly version of the bank now.
You go long Mercantile, MBWM. And if you want to be market neutral, you short a high efficiency peer that is already priced for perfection.
Okay, walk me through the logic. How does this play out?
You buy Mercantile today, you sit on it through 2026, you collect a decent dividend, and you watch them use that Eastern Michigan liquidity to grow loans in Detroit. Then, as we get closer to 2027, the market starts to price in the conversion.
The systems merge, The duplicate staff goes away, the software costs drop by half.
And suddenly, earnings scream higher, not because they sold more loans, but because the costs vanished. The hidden earnings that are currently being eaten by the merger are revealed.
And the multiple expands because the market goes, oh, wow, look at this profitability.
Exactly. You are essentially front-running the inevitable efficiency that the market is too impatient to wait for. You are buying $1 of future earnings for 80 cents because everyone hates the waiting period.
But isn't there a risk? I mean, 18 months is a long time. What if they screw up the Detroit expansion?
That is the risk. The leaky bucket. If they spend all this money hiring teams in Detroit and they don't get the 5% to 7% growth because payoffs are too high, then you cut the costs in 2027 and you're just left with a smaller bank.
So you are betting on execution. You are betting they can find the borrowers to use the fuel.
Yes. But with tangible book value growing at double digits, you have a massive margin of safety. You aren't buying a distressed turnaround. You're buying a high-performing bank that is temporarily wearing an ugly disguise.
I like that, the ugly disguise trade. It's basically betting on the fact that algorithms can't read a calendar fast enough, or at least they don't value the future as much as the present.
Time arbitrage is one of the few edges left in a market dominated by high-frequency trading. Machines are great at now. They aren't always great at 2 years from now.
So to wrap this up, we saw a workmanlike Q4 from Mercantile Bank. A solid earnings beat, a slight revenue miss, but incredibly stable margins in a rate cut environment.
And a transformational acquisition that wasn't about cutting costs, at least not yet, but about securing liquidity. They have the fuel now.
The question for 2026 is, can they find the borrowers in Detroit to use that fuel without wrecking the expense line before the 2027 finish line?
That's the execution risk. But with tangible book value up 11%, they have earned the benefit of the doubt in my book.
A fascinating setup for anyone watching the regional banks. Pull up the charts, check out the tangible book value history, and see if you have the patience for the 2027 play. We will be watching that date closely.
Absolutely.
Thanks for tuning in to Talk Tickers. Keep your eyes on the data. Don't let the headline numbers fool you, and we will see you on the next tick.